this Wednesday afternoon, the 11th of March 2015. I'm Rob Colville, and today we're going to talk about trend trading and how we can essentially just use it to make as much as we can in a stress-free way and carefree way as possible. So just to cut a long story short, I'm just going to go through these. My name is Rob Colville, founder of thelazytrader.com. I'm a set-and-forget swing trader, and I trade forex, stocks and commodities, and I've trained thousands of people around the world how to trend trade as well as trade reversals. And when I'm not trading, I like photography, mentoring for the Princess Trust and photography. But I'm pretty sure you didn't turn up this webinar to hear me talk about myself. So without further ado, let's go on straight to the pith. And I just want you to have a quick sight of this disclaimer. Standard stuff, really, and really want to talk to you now about the fundamentals of trend trading. Well, you've probably heard the old cliche, the trend is your friend until the end when it bends, and there's no real word of a lie in that, actually. Trend trading is one of the easiest ways to make money routinely, and it's certainly one of the safest ways. The rather tedious fact that we all have to accept, though, is that markets don't trend most of the time, and certainly if we look at a number of the currencies across the board, we do have a few trending markets, but most of them are range bound, notably the crosses. So if we're to identify, and we'll talk about some selection a little bit later on, if we're to identify several markets which are trending and ignoring the rest, we could do very well potentially from just sticking to those trending markets. By following the trend, you're piggybacking the overriding sentiment in that move, rather than trying to pick tops and pick bottoms. People who do that essentially wrong a lot of the time. People who trade reversals are essentially wrong, I think it's 80% of the time. But when they are right, people who trade reversals, they stand to make a lot of money. But in order to be safe, if you wanted a higher probability outcome with a smaller reward, with the, well, I'm not going to say guarantee, but with the added benefit of more safety, then trend trading is the ace up your sleeve here. Okay, so a big component behind trend trading is the C word, cyclicity. Yep, you might have thought of it as something else, but cyclicity is the overriding engine, if you like, which governs cyclicity and perpetuates it in both downtrending and uptrending markets. All right, so what we essentially want to look out for cyclicity is key highs and key lows. I'm pretty sure a number of you in this room, I know I recognize a few of your names. Fantastic, welcome back. I would have heard me mention this before. And all we need to do in an uptrending market is to buy the retracement, buy the bounce essentially. And in a downtrending market, sell the pullback or sell the rally, you might have heard it referred to as. Okay, but is it that simple? Well, it certainly can be, but we just need to be patient and disciplined, and we need to be very pragmatic about our selection when it comes to trend trading. Okay. So we'll give you a few examples here. I know this is all very simple looking stuff with this animation. We'll look at the actual markets very shortly. But this is a beautiful upward trend. We've got key higher highs and key higher lows, otherwise known as higher peaks and higher troughs. I know a lot of you might have read in textbooks or from your own research that for a trending market, we need trend lines to conform. Well, you could do. That's absolutely fine, but it doesn't need to conform to a trend line bounce in order to be a trending market. What we essentially need are key higher highs and higher lows, upward moving waves, essentially. Sure enough, we could potentially see support on a trend line, or indeed a dynamic level of support like a moving average, whether it's the 20 or the 50. In an upward moving market, they will offer reference points for us to potentially cite an entry into, in this case, an upward moving market. And we can see, and I'll show examples a little bit later on, of markets where we get interactions of these moving averages. And moving averages are fantastic, objective, dynamic levels of support in an upward market and resistance in a downward moving market. Okay, so in an upward market, we're just simply looking for higher highs and higher lows, and that's it. Nothing really that earth-shatteringly difficult about that, or is there? So if we are in an upward trending market, I do want you to essentially look out for a warning sign that the trend has run out of steam. A lot of people fall into this trap. When we're in a beautiful upward trending market, they ignore the fact that momentum has been lost, and whatever has supported price before, it has broken down. Like in this example here, we've got a lower high here, which is a sign that the trend has run out of steam. Price hasn't exceeded the previous high here, and price has closed below what was the dynamic level of support initially supporting price action here. So that's a warning sign, okay? But if you're following the trend, the chances of this trend failing are certainly less likely than if you're trying to pick a top or a bottom and trading a trend reversal in that sense, okay? So we talk about the trend and what makes a good trend in terms of cyclicity, but how about this? I always like to think of a clock face, metaphorically speaking, and it's no kind of like, there's a lot in it where you'll say to yourself, well, the steeper the trend, the less likely it is to bend. When the trend is steeper, it's a sign to us that we've got good speed and momentum behind this trend driving it. And a lot of people do essentially trade the wrong kind of trends, the trends which are moving very gradually sideways. So what I like to do in order to keep this objective is to only trade a trend, which is, you imagine the clock face between 12 and 2. You imagine a trend between those two areas, 12 and 2, let me go back, then that's far better. The trend is far steeper, upward moving, than if it's moving slightly sideways, and probably in between the moving averages. Okay, so that's ideal for us. But if the trend is cycling up between 2 and 3 p.m., the equivalent of, then the momentum and the speed isn't so good. You might have to wait longer for the trend or for your trade position to realize any profits whatsoever, if you had the confidence to trade it in the first place, that is. All right, so another big factor is moving averages. Moving averages are absolutely fantastic in confirming a trend, and for me, they're one of my favorites. And a lot of people ask me, what moving average combinations do I use? And it's very simple. I like a short, medium, and long-term moving average, really. And the short-term one I use is the 20, the medium term is the 50, and the long-term one is the 200. Exponential moving average. The reason why I use exponential is because the moving average is slightly more weighted in favor of current conditions. And this is, for me, a good thing because it really just reflects what's happening right now, as well as gives us perspective into the past. So one thing I look at as well, or three things, should I say, when we look at moving averages and how they interact with price, is the order, angle, and separation. How price is essentially interacting with the moving averages. Well, in this diagram here, we've got the 200 above the 50 and the 20 above the 50. Okay, so we've got the 20, the 50, and the 200 in that order, and we've got price above it, which is a great sign to us. Okay, that there's good speed and momentum in this market. Okay, so the angle, all the moving averages are moving or sloping upwards, and they're separated between each other. There's good separation between them, which once again reflects that this is a fast-moving market and the bulls are well and truly dominating. Okay, so these three factors behind the moving averages, order, angle, and separation, are very good considerations for you to take away with you today. And if you're just to simply say, well, I'm only going to trade price action if we've got good order, angle, and separation in a trending market, then you could do very well long term with this. Okay. In a downward trend, it's exactly the same, except the other way around. Just imagine the opposite of what I've just told you. Okay, so we're looking for key lower highs and lower lows, and well, peaks and troughs as well, essentially some of you might refer to it as. And of course, we could get interaction of a trend line or a dynamic level of resistance in this case, which is the 20 moving average, which is tightly tracking the price action, like so. Okay, so we can see that low highs and low lows, the bears are well and truly in control of this move here, and we'll relate this to, say, a currency pair like a Kiwi dollar, which is one which we're in short at the moment, and the trade we took a couple of weeks ago was absolutely textbook based on this trending strategy which I'm teaching you. Okay, so another warning sign, just like we had the lower high in an upward trending market, the warning sign in a downward trending market is the high low. And this is a sign that the bulls have come back into the market and they've overpowered the bears. And if we do get this high low, it's a sign that the strength is starting to wane, and it's essentially a warning sign, an early warning sign. Okay, and it gives us a good heads up as to how the market's changed, and how as traders we need to adapt to this and behave just like water, be fully responsible and appreciate that the market can do anything at any time. And we need to be prepared for that, unfortunately. Just because we've taken the day off work to trade, it doesn't mean that the market's going to yield us an opportunity just because we want to trade. It will do its own thing regardless. As frustrating as that sounds, that's the way it is, and that's the way it's always has been, and the way it always will be. Okay, it's an inconvenient truth, and certainly when I was new to trading, I really resented that. But if you just let go of that and just appreciate that, if we're trading on the hard time frames, like I certainly do on the daily and the weekly, then we can see these potential trend-based opportunities lining up from a mile away, and you have a very good idea as to when you can potentially intercept and trade it long. And just simply forget about that trade and just let it do its thing. Okay, and that's the great thing about set and forget trading on the daily and the weekly time frame, because it's very hands off and you can go about your merry day or week without really having to worry too much about the trade or what the market's doing, what Ben Bernanke is saying, or the Bank of England, or the Bank of Japan, or Draghi, or anyone like that. It doesn't really matter. We're following the trend. We've got the big boys, the big dogs on our side, and we're just piggybacking the moves and the overriding sentiment in the market. Okay, so just like we talked about the clock face in the upward trend, we're looking at the downward trend, and we just want to imagine a clock face and the trend, downward trend, making lower highs and lower lows, intersecting with this clock face. And we want to really just fit it in between 4 and 6 p.m. And the steeper the trend downwards in a downward trending market, that's a great sign to us that we've got confirmation of good speed and momentum in this downward moving market. And this is what we want as traders. We want to be in our trade and we want to get our outcome in as quickly as possible, essentially. We don't want to be dithering around. So we've got a fast moving market to take advantage of. With that in mind, then fantastic. We want to piggyback that. We don't want to be dilly-dallying about for longer than is necessary, because it means that we've got an undue exposure to the market, and we might have to, depending on our other exposure and other positions, we might be sacrificing having the opportunity to trade elsewhere on better opportunities. So it's always a sweet spot when you've got a position in an up or down trading market where you've got confirmation behind you and you're able to move your stop loss to break even as quickly as possible. Then you've got essentially a free trade, and that is the sweet spot. And when you're locking in profit routinely as your trade is perpetuated, or the market is perpetuating in your direction and unfolding, then that's a very good position to be in. That's exactly what we should be doing, trend traders. Okay. So once again, order angle and separation in a downward trending market. It's the same. We want the 200 to be above the 50 and the 50 to be above the 20 moving average, and the price action to be below all three of them. That's a great confirmation, an objective confirmation. We're in a downward trending market where we've got just the moving averages doing that. If we're to take price action, the bars, OHLC bars, or indeed the candlesticks off our charts, and we'll just have the moving averages with the 200 above the 50 and the 50 above the 20, with order, angle, and separation between them, would just tell us we're in a downward trending market, and this is what we want. And this is absolutely fantastic way of just objectively seeing what kind of market we're in. And the more objective we can be, really, with our trading, the better. And the less we have to think and make a decision based on emotion, the better as well. So if you've got moving averages confirming what the market's actually doing, and we can just respond to that, then fantastic. Okay, so order, angle, and separation, those three buzzwords yet again. Okay, so in this hypothetical example, forgive the diagram, price actions below, we've got good order, angle, and separation, and there we go. Right, so now you've heard me prattle along about the theory. I'm going to really just apply this now, because there's no substitute for actually talking and applying this to what's happening right now in the markets. We could talk about hindsight examples and diagrams for the remaining half hour, but I'm pretty sure you want to take this away to the markets right now, and I'll show you what currencies are trending and how we can take advantage of them. And one which I'm going to do this to is, you might have heard this before, Singapore dollar. Where is it? Here we go. So this one has been very good to us over the past 6 months, and you don't really have to be well, even to the casual observer, I mean, this is in an upward trend, and we've got the 200 below the 50 and the 50 below the 20. We've got order, angle, and separation between them all. Okay, they're all sloping upwards, and what is more, we have a trend line. Trend lines aren't compulsory, by the way, but all we want to do in order to trade a trend where we've got the moving averages in this order at this angle and with the separation is just simply buy the dip. So at the moment, we're just waiting for things to get a little bit worse for the US dollar against the Singapore dollar before we can take advantage of a continuation to the upside. Because looking at this, I think it's very reasonable to say that it's far more likely this is going to go up long term than it is to go down. And certainly all the way back in mid-January, we had an opportunity to go long here. Had an inside bar after a pullback. We can see that buying the dip was a good thing there. Let me just go back on a simulator just to show you exactly what clients did. So we could see here already at this point, mid-January, we had order angular separation at the moving averages in this order, and we had an inside bar here after a phase 2 retracement. We had a reversal pattern on a smaller time frame. In fact, I believe it was a symmetrical triangle, but people who wanted the confirmation of a break to the upside, they had it. And then the continuation to a higher high occurred, hit what was now the top of the channel, profits are taken, and then people who are long on this one were looking and waiting for a pullback to occur. And sometimes these pullbacks, we can see that traditionally we've got the previous swing high, once it's been breached, has acted as support on the way down. So those people who were waiting for that, well, they didn't get an opportunity this time around after the pullback, unfortunately. Sometimes that happens. On this occasion here, I know we've got a big hammer bar or bullish pin bar reversal, whatever you like to call it. I know that tens and hundreds of different names for the same candlestick essentially here. So this one was a very bullish signal. It was engulfing the previous bar where the high of, the 26th of February took out the high and low of the 25th, and it low tested, closed above the 20, which had been previously tested, and it's made a higher low. Then what people could have done is place an entry just above the high of this bar, stop loss below the low, and targeted the previous swing high, or indeed a higher high. Unfortunately, the reward to risk in trend trading isn't as good as it would be if you're trading reversals. As you can see here, the reward to risk was pretty lousy. You've got a 0.5 to 1 reward to risk trade if you're risking 1% of your trading account, which is not that great. But if you are targeting a higher high, please bear in mind you've got the advantage of the overriding move on your side. Then you do have a better reward to risk. You've got roughly a 2 to 1. And those people who did take it, certainly some of our clients took it off their own back, there is a 2 to 1 profit target hit. But guess what? You might have missed this trade. It doesn't matter. Markets will always move, generally speaking, in the same direction as they have been today, last week, the week before that, and so forth, certainly if they've been trending. Okay, so all we're waiting for now is for price to come back down and test what could potentially be this old swing high, which has been broken, was broken on the 3rd of March, waiting for the price to come back, test it as support, and intersect with the 20 moving average, which has been previously tested before a move to the upside yet again. Okay, so this market is still looking good for a trend-based market, and this is dollar versus the Singapore dollar, a very steady, stable currency pair to trade. The spread might be a little bit, the spread might be a little bit wider with your broker because it's slightly less liquid compared to many pairs out there. But you know what? It looks like a very, very reliably predictable market to trade compared to a lot of them out there at the moment. And there is a lot of undue attention, I think, on the majors and the minors when we've got some of the more obscure currency pairs, which actually do have clearer opportunities for us. Okay, so I'm going to move on now and talk to you about the Kiwi dollar. This is one which we took a couple of weeks ago. There we are. Okay, so all the way back on the 26th of February, not too long ago, by the way, although for people new to end-of-day trading, it might feel like an eternity, we had just a classic setup, really. I mean, this was such an obvious-looking setup with decent reward to risk. It was a retracement back to this previous level of support, testing as resistance, and it's, well, an obvious symptom of a downward trending market is where previous support is tested as resistance prior to a continuation to the downside. What else looked good about this one? Well, the clues started coming in. Not only is it in a downward overall trend with good order angular separation between the moving averages, this level also coincided with the 0.618 Fibonacci rejection. You see what I just mentioned there about the 200 above the 50 above the 20. So we've got that. We've got good speed and momentum behind this market until we get this rather tedious cross up of the 20. They call it a bullish golden cross, sorry, where we get the 20 moving up above the 50, then that would be a warning sign. But the fact that it hasn't done that is encouraging. So what we did was we simply placed an order at the break of the low of this evening star, bearish pin bar reversal, high test bar, whatever you like to call it. It's really the same thing, isn't it? It's got a tail and it's got a body, open and close in the bottom third of the bar, and it's testing the 50 moving average, this dynamic level of resistance, which has been tested numerous times before in the past. So you can see how my choice of the 50, 20, and 200 wasn't just any kind of arbitrary number. Certainly, when I see price interacting with these moving averages, it gives us a very good dynamic level of support or resistance, very much like a trend line, except unlike a trend line, the requirement is of moving averages is far less tests for it to be a valid level of dynamic level of support or resistance. A trend line typically you need 2 or at least 3 touches or tests in order to qualify as a trend line. With a moving average, all we need is 1 previous test, and that's it. It's been qualified as a dynamic level of support or resistance. Okay, so essentially with the Kiwi dollar, we're in this trend at the moment. Sure enough, we went through what I call purgatory for a good week, where we almost got stopped out of a full hit. But you know what? I mean, this is the daily. You've got to give it some slack. And the great thing about the fact that it was a bearish pin bar reversal was the fact that we were able to put our stop loss snugly behind this point of rejection here. And this is why I like trading pin bar reversals, purely because you can put your stop loss at quite a tactical point at where if the stop loss is triggered and you've made a loss, then the trade setup is well and truly invalid. And there's no real kind of psychological loss from this or emotional loss from this. So now, non-farm payroll, of course, was great for the dollar, not so good for anything paid against the dollar. We're all the way down here. We're up about, if we're risking 2% on this one, we're up about 6-7%. The previous swing low here is our first target, but of course, there's going to be a much longer way to go for the Kiwi dollar. And what I'm going to do is target shoot where I think it could potentially go long term. Please be rest assured that markets can do anything at any time. It might not go down to here, but I do think that it's a very good chance that it could potentially go all the way down to 0.6744. And you know, those people who are in this trade at the moment, it's probably a good idea. What I always say is bank some profit and take half the position off, and then leave the remaining half the position to run, essentially. Okay. I've got a question here. Do you ever counter trend trade? Yes, I do. I trade reversals as well, but that's a different kind of subject for a different webinar. And I believe we've talked about reversals before in previous webinars, but it's something I plan to cover again in the future. And yeah, it all depends on your individual style, really. Whether you're a reversal or a trend trader, I like to do both, really, because when I'm right with the reversals, then the rewards can be out of this world, essentially. Okay, so I hope that answers your question. FX Boyke, your familiar name. Welcome back. Good to see you. So, okay, so that is the Kiwi dollar. I'm just going to go on very quickly to talk about the Dow. I know this is not currency. I'm sure I won't get into trouble for talking about it, though. Let's hope. So you can see here that looking at the quantitative easing and the fact that we've had all this funny money printed worldwide has perpetuated stock markets to break all-time highs. We're seeing that the Dow, okay, it's in a phase of retracement at the moment, and we're making higher highs and higher lows. We can see this more acutely on the weekly. And yeah, it's quite obvious what we're looking for here. We've got higher highs and higher lows, and we're just waiting for a retracement. We can see that it's tested the 50 moving average before, once, twice, so thrice maybe. Well, to be honest with you, we've got a very good heads up that it could potentially happen again. So we're just waiting for the Dow to come down to the 50 moving average, and we're going to wait for a signal bar to go long and essentially just buy the dip in this upward trending market. Okay, and you know, a lot of people, you see written in all these reports everywhere that stocks in Europe and Britain, UK and Asia and America overhyped, overinflated. But you know what? We trade what we see, not what we think. And to be honest with you, you'll be reading those kind of publications. I know sometimes we just can't help ourselves as human beings. They serve more harm to our trading because essentially all the analysts in there, I mean, sure enough, they're right at some point in their careers, and no doubt when they are, they'll make a big deal about it. But essentially, it depends on the time frame they're talking about, okay? And there are a lot of people who make these predictions, and that 2010 is going to be the year of the next economic collapse. And, you know, every year since 2008, Different pundits at different times have been coming out expressing their grave concern that stock markets are going to tank yet again to all-time lows, but we just haven't seen it. Okay, we've just been seeing a beautiful trend upwards, and as a technical trader, we need to follow that trend. And I'm talking about the Dow here, but regardless of it being a Dow, just pretend it's a currency pair. It's very straightforward in this sense. I mean, people who trade price action and supply and demand, then this kind of strategy and these principles are relevant to all markets, whether it's currencies, stocks, commodities, you name it. It's just the same principles, but on different different wrapper, basically. All right, so let's going to move on now. I'm going to move on to Euro GBP. I know this is one which a number of people have been looking at. So here, even on the weekly, we can see that we've been trending very nicely here, Euro GBP, and we've been trending beautifully since 2008. It's a very obvious looking downward trend, and we've been seeing key phase one, key phase two areas. So phase one, sell area, phase two, retracement. We've been a huge phase one again, all the way since 2013, where we've just been going down, down, down. We've broken at the bottom side this channel here. And we're just waiting, essentially, for a pullback in order to simply sell the rally, in this case. And if we look on the daily here, we can see that we've got 200, 50, and 20, got good order angle and separation. So we're just simply waiting for some kind of retracement. I know it's easier said than done with a lot of these currency pairs because they're so overextended in a lot of them, that we just need to wait for the pullback, unfortunately. But I do want to talk to you a little bit about gold, because this is something which is slightly more relevant, and you could potentially see an opportunity here sooner than you would something like euro, which is grossly overextended. If we look on the, here we go, look on the weekly here. There we go. We've got a downward moving channel here, making gradual lower highs and lower lows. Excuse me, I'll just get some of this clutter off the screen. Gold on the weekly. And we can see here that, okay, we've made very clear lower highs and lower lows as well. So we're on schedule to, based on what the past has done before, make a lower low. So we go down to the daily and we see, okay, so we've got that perspective on the weekly. Do we have an opportunity to potentially get into this one on the daily? Well, we did a few weeks ago, all the way back in, well, I say that, it wasn't that long ago. It was, the 2nd of March. We got this bearish pin bar reversal here. It was simply selling a pullback. There we go. So we knew, if I look at the weekly, that we're due to make a new lower low on the weekly. But on the daily, we're just simply waiting for a breather in order to position or get into a position in order to ride this longer term move. So I know a number of people who actually place their order just below this bearish pin bar reversals low, minus spread, minus an extra dollar, stop loss above the high, etc. And they're just riding it down, okay? So lo and behold, in the meantime, we could just wait for another pullback, wait for things in this downward trending market to get a little bit better in the form of a retracement or a breather, pullback, whatever you like to call it, before they get worse, and we just need to wait for an activator bar or a signal bar in order to jump in on that move, okay? And this has been just adaptable with the market we have in front of us. I mean, you can see here with the moving averages that we've only just really, I mean, because this trend is so kind of gradual, really, that the moving averages aren't as kind of there's no real separation between them, but they're still valid. There's still separation, they're still angled, and they're still in the right order. Okay. Another question here. Do you trade ranging? Yeah, ranging markets are good. Absolutely love ranging markets. I will show you just very quickly what I like to trade in ranging markets, and it might just seem very simple, but it's very practical nonetheless. Looking on the weekly here, this is just, put simply, this is pound New Zealand, and we've got a stonking level here in the way of price. It's 2 spot 100, and we're just waiting for price to come up to here, and we're anticipating price to bounce off it. And I know some aggressive traders who trade supply and demand levels, and this is something we've done another webinar on previous to this one. They're just looking to simply sell on the level in anticipation of a whiplash off the level. Okay, this is a range-bound reversal strategy, not really for the purpose of this webinar, I will say, but just to give you a heads up. And it's always good and to essentially have a range of strategies to be adaptive with markets, because markets, they're always evolving and expanding and contracting, and it makes sense to be adaptive to that rather than just waiting for the perfect trade. Because when you're always waiting for the perfect trade, the perfect setup which ticks all the boxes and is absolutely textbook, if you waited patiently for that and it goes wrong, then it's very demoralizing. So I'm not just saying you should break your rules by trading at all. That's not what I'm saying here, but I'm simply saying that trades which fulfill your rules but look imperfect are absolutely fine to take, okay? And always work the reward to risk element to it as well. And if you do get a valid setup, always ask yourself, okay, well, what is the worst possible thing that can happen if I lose this trade? I.e., if you've trade sized and you've risked only a small amount, then the maximum you lost is only 1 or 2%. But if you've decided not to take that trade out of fear, then you know what? You missed out on a decent opportunity that could have made you good money. Okay. Fundamentals, yeah, I mean, fundamentals will always perpetuate the trend. Okay, that's the thing. It's already inbuilt into price. I mean, sure enough, I mean, markets will always build in the fundamental element to it. And say, for example, if a central bank cuts or increases interest rates, then there's going to be a sudden adjustment in that market if the market wasn't expecting that. Okay, but the price will always adjust to that. And as certainly retail traders, we can respond to that. Okay. For example, with the Swiss, with the SMB's notorious decision to remove the cap, remove the floor with Euro Swiss, and of course to charge more interest to people wanting to have money in Switzerland, that caused the dollar to absolutely collapse against the Swiss franc. But you know what? At home, as retail traders, I mean, what could we have done about that? Not much, really. But we know to stay away from this one until further notice, and I've been staying away from this one for quite some time, really, until it escapes this rather nasty range here, which is enormous. Okay, but there are plenty of other currencies to trade in the meantime. All right, so down 30 Euro GBP. Yep, we covered those examples. So I'm just going to talk to you now a little bit about Euro New Zealand. I mean, we do have a lot of examples with the Scandis as well. Okay, I know a lot of people will choose not to trade the Scandis. Like this one here, for example. This one isn't really the best example. Let me show pound NOK. This is one where a lot of people are absolutely horrified to hear me mention because it's so obscure. But you know what? It's been trending beautifully for such a long time now. And we actually caught the beginning of this trend in 2013, trading it as a reversal. So just going back to the point about reversal trading, what we did back I was in Malaysia back then. And I remember very clearly trading on the daily, just a pin bar reversal, halfway down the bar, stop loss below the low, and take it all the way up to there and scaling up this move. But what was a reversal, let me zoom in just because I know it's very small here. What was a high-risk reversal trade soon evolved into the confirmation of the trend upwards. And we had confirmation of this as soon as we had several higher lows, and we had the crossing of the 20 above the 200 and the 50, and essentially order angle and separation. We got it after about half a year on the daily. So these trends are very well established when they've been confirmed with moving averages and higher highs and higher lows in a upward trend and lower highs and lower lows in a downward trend. Okay, so pound NOK is a very decent example, and it's just been going up ever since. As you can see here, there's always the kind of the wise crack saying, well, if you got in here, why aren't you still in it? Well, to be honest with you, I was quite happy with what I did take off the table back then. But I have been simply looking to buy the dip ever since, really, and I'm just waiting for another opportunity to simply wait for a retracement and to buy this retracement when I get it. Okay, so we're just waiting, lo and behold, for price to come back down. We've seen it testing the 50 moving average. We've seen that we've still got good order angular separation between the 20, the 50, and the 200. And we're just waiting for a pullback here. We've got a decent level here. This is almost like a box, like so a rectangle. So we're just waiting for price to come back down, potentially test on top of this one. And by the time it does, maybe it will intersect with the previously tested 50 moving average. And then we've got a decent correlation. And we look for correlations with trading because they just give us an extra reason to be comfortable in our trading decision. But remember that anything can happen at any time. I mean, just because it's trending upwards and you've got everything lining up in the trade, I mean, certainly people who are long on the Swiss franc, Swiss franc, apologies, nobody could have seen this coming from the SMB. And I know a lot of people say they've lost a lot of respect in their ability to break news in a responsible fashion to the market because of this enormous move spike. And certainly well, a lot of people wiped out, a lot of funds lost a lot of money, and yeah, it wasn't very pretty all around the world. Okay, so yeah, but it was a black swan event. That's what you got to remember. It's happened very, very seldomly. Okay. So I would just say, just keeping the currencies on our watch list for trend-based currencies, we can simply say anything in a downward trend below the 200, 50, and 20, like the Aussie dollar, like euro, like the pound, like New Zealand dollar, are good to keep on our watch list. We're just simply waiting to wait for buying to happen. Are you waiting for a retracement? So looking to simply sell the rally in this case, if it's a downward trending market. Euro dollar. Okay, well, absolutely. We can't really argue with this one. We've got great order angular separation between the moving averages. We're in an obvious downtrend here. You can't really dispute that at all. We're just waiting for a pullback, i.e. things to get a little bit better and for us to essentially be able to sell a rally. But I don't really see any rally anytime soon for euro. I imagine after this extension here from this pennant, we're just going to see some range-bound action and a continuation to the downside. What I want to talk to you, though, about is dollar CAD, okay? Just like euro has done over the past few weeks ago, we had this, you can call it a pennant, you can call it a symmetrical triangle, whatever you like to call it. It's just broken out here, and we've got confirmation that it's going to the upside as well. We've got a key level in the way, but you know what? I mean, this is such a horribly big move upwards since 2012. We've got this key level here. What I do want to do, though, is on the daily, for the meantime, I just want to wait for price to retrace back a little bit, make a higher low after this breakout, and then potentially get in long there. But I'm going to be quite aggressive with managing this trade because we are in advance of such a big key level here. I mean, it could break, it might not, but if it does, great. If it doesn't, then at least the trade's managed. Okay, it's going on to pound CAD. Well, with the British pound, it all really hinges on, for long-term traders, this election this year coming up in May. I mean, I think it's fair enough to say that if the Tories get in, the Conservatives, David Cameron, who is a posh toff, the markets will respond quite well to that one. But if Ed Miliband gets in, who I personally don't like very much, the markets won't like that very much. And I think that's already been priced in. But as the Tories are already in a bit of a head start, the markets haven't really reacted in any way, shape or form. We've just got the whole pantomime of TV debates, but we'll see. But pound CAD, let's get back onto this one. Let's have a look on the weekly. I haven't looked at pound CAD in a long time, to be honest with you, with interest. But what is interesting here is the fact that we've got 1.936 in the way. Got this bearish pin bar reversal on the weekly. I mean, it looks pretty bullish, to be honest with you. Had a huge move up. Hesitation here, token hesitation. Those people who trade reversals would have tried to have taken this move, but can everyone else see the screen? Someone's screen's blank, I see. Can everyone else see the screen, or am I... Yep. Okay, great. Okay, sorry, that one person is, you're on your own there, mate. I don't know what's wrong. Maybe just turn up and turn your computer again. That's what I usually do when I've got a problem with my computer. It seems to work with me. That's the old classic, isn't it? But anyway, I would say with pound CAD, I'll give it a wide berth, to be honest with you. I mean, I don't really see anything that exciting about it. On the daily, sure enough, we've got order angular separation, 20 above the 50, 50 above the 200, which says that we're bullish, but we just don't have a really nice arching long-term trend. We've just broken out this rather tedious, choppy range here, or retracement, choppy retracement, I would say. So, yeah, I mean, there are better currencies out there, like we just mentioned, anything trending, cycling nicely, with the moving averages on the right side of them, okay? So if we're looking For downtrending markets, like I mentioned, I would refer to euro, British pound versus US dollar, Aussie dollar, Kiwi dollar. If we're looking for upward trending markets, then dollar CAD, dollar SEK, pound NOK, Singapore dollar, the Dow, and I forgot to mention gold as well for a downward trending market. I mean, gold, face it, is a currency really. It's used as money in exchange of goods, so we can include that into the realm. Okay, so there are our trade examples, and hopefully we've managed to demonstrate that trend trading isn't so difficult or time consuming. There is one thing I want to share with all you good people who've taken the effort out of your daily schedule to watch this. I like to reward people who are serious with their trading, and one thing I want to do for you is offer you access to our flagship Ultimate Learn to Trade program, which essentially teaches you how to trade from as little as 10 minutes a day. This is membership access to our VIP club, where we've got access to all everything we do: trade ideas, market analysis, strategies, psychology, you name it. Valued at $1,997. We're going to give you a huge discount from our web price today, and it's going to be only $100.80, providing you take advantage before midnight tonight GMT. Okay, so in order to secure your place on this program, which has had great reviews, by the way, check it out yourself. Do your due diligence. You don't have to believe anything I say, by the way. But by all means, have a look before you buy. But as a member, you'll get access to all our weekly market analysis, trade ideas, how to trade, how to view the market, trader hypnosis. This is our new cutting-edge audio book program. We've got pattern recognition software, loads of bonuses. We've got guest traders that come in as well. And if you want to take advantage, then please go to thelazytrader.com/forex training, read the terms, use the promo code FXStreetMarch, and you'll get your discount. Okay, so this is for today only. If you're not happy with it, we'll give you a refund. Very seldom do people take us up on this refund, but just to give you full peace of mind that you've got nothing to lose from taking advantage of this offer. Okay, but hopefully we'll see you on the other side. If not, no love lost. We'll see you next month. Okay, if anyone's got any questions, just drop us an email. If you want these slides, which I used for the presentation just now, drop me an email, rob@thelazytrader.com. And I'm just going to do that now. I'm going to write that down so that you can have that. There we go. All right then, so I hope we've got all your questions answered with trend trading. If you have any, drop me a line or ask me now. Hopefully we'll see you on board the Ultimate program. If not, no love lost. How long is the membership? However long you want it to be. If you sign up, you can be a member for a year, you can be a member for 2 years, you can be a member for 1 day. It's entirely up to you. All right then. Well, thank you all for coming. Great to see you all. All the best. Happy trading.